Thank you, Joe, for the awesome introduction. Again, my name is Ray Hayden. Let me just get this presentation a little bit bigger here, and everybody should see that on my screen. Continue there. Okay, like Joe said, I am one of the consultants with the Wilkes University Small Business Development Center. Before we get too far into the presentation, I'd like to go over my quote-unquote agenda for today. I'd like to start with a brief overview of what we do and a bit of a housekeeping slide. Next, I'd like to talk about really why is cash flow important, especially with regard to the whole COVID-19 pandemic. It's really been a big ticket issue when you get right down to it. I'd like to go in a little bit as to what is cash flow and essential thoughts to get out of this course. We'll go over some key concepts regarding cash flow. I have a cash flow tool that I'm excited to share with you, some metrics, some final thoughts at the end. If there are any final questions or comments, I'd love to entertain those for you guys. And once we're done, everybody is free to go. So that's a great way, I think, to start the weekend on a Friday with a cash flow presentation. So let's go with what the Small Business Development Center is, all right? So we are an operation that's funded by the SBA, Pennsylvania's Department of Community and Economic Development, and Wilkes University. And from our funding partners, we're able to provide no-cost confidential consulting. We provide training and education at generally low cost to help folks that are looking to start a small business or who are presently in business make appropriate decisions for their operation. So one of the things that a lot of folks confuse us with is the SBA, our funding partner, as I had mentioned. And the SBA provides loans and grants, and you probably saw a lot of that assistance with the EIDL loan program, Paycheck Protection. That is not who we are, even though they are a funding partner. That being said, a lot of folks will leverage off of the technical assistance and consulting from our office and other SBDCs nationwide to facilitate the process of applying for loans, especially. We do not provide legal or accounting advice. We actually have an awesome partnership with a group out of Penn State, the Penn State Law Clinic, that can offer legal, at the very least, preliminary legal advice to get you started. Accounting advice is best served with your accounting or tax professionals. And then finally, I've articulated the 5-county region that we serve as part of the Wilkes SBDC. General housekeeping and management of expectations for you guys. You know what? I really do appreciate participation. So as appropriate, feel free to jump in. If you have examples, anecdotes, things like that, that kind of positive participation for me as a presenter is very welcome. The one thing that I want to stress to folks, and I always do this for all my clients, is that nobody at the SBDC can really force you to do anything that you don't want to do. We're going through cash flow, some ins and outs with regard to the management of cash flow. And ultimately, what you do with the education, I hope you get something out of it, but I can't physically make you manage your cash flow if you don't want to. I can't force you to use tools if you don't want to. And ultimately, you have to do what's right for your operation. Relative to that, as I had mentioned before, we're definitely an education endeavor. So I want to make the distinction between education versus solutions. The realization of solutions is definitely up to the small business when you get right down to it, all right? What you do with that education, how you plan to deploy it in terms of your operation is totally you. This is essentially a bird's eye view of cash flow management. I don't want to it's really hard to get into the minutiae of all things cash flow management related. So please take this as something to apply practically to your operation. And finally, similar to that previous slide, I have worked in government finance. I used to be a commercial lender. I am definitely not an accountant. So what I would suggest is if you have accounting related questions, to please reach out to that professional. All right, guys, so with that housekeeping out of the way, let's go into why cash flow is important. Now here in this slide, I've shared a couple of general statistics for you, all right? And I just want to take a moment, take a look at these because I don't know, has anybody Did anybody find this kind of surprising? Because when I was looking at things and preparing for this presentation, despite our roles as consultants, you know, I really found this eye-opening. I mean, especially that third point, the 82% of businesses that fail due to cash flow issues, that's a big deal. And really that last one, the top 10 reasons why businesses fail, 8 of those reasons revolve around cash flow management. That is substantial. And the thing about these statistics, folks, is that these were all developed, these were all procured prior to the real COVID onset, all right? So even before then, these were big issues, or cash flow in general was a big issue. So now that we go into like COVID-19 and have that factor to take into consideration, you know, figures are amended, and these are they're pretty eye-opening when you get right down to it. And I just want to share with you anecdotally is that everything is kind of tied together. Very rarely in my experience working with small businesses, do small businesses exist in vacuums, right? So like something that's affecting a small business cash flow wise is going to affect another small business. Something that's going to affect the clients and customers of a small business. I mean, it's practical when you get right down to it. It's going to affect the small business. And even though there are ways of augmenting cash flow now, especially with COVID-19, now it's more important to take a look at how to manage your cash flow and the different strategies of cash flow, and then the associated pros and cons. So with that all out of the way, what is cash flow? And you know what, this is a conversation, this is a topic that can get as complicated or as simple as you want to make it. So I'd like to start from the simple end of things, right? The basic concept of cash flow is money in and money out. You'll probably hear me refer to that a lot of times throughout this presentation. Now, with that said, cash flow generally is founded upon 3 general categories, and I've listed those down for you. That's operating cash, investing cash, and financing. And think about it. If you think about where your cash comes from as a small business, or if you're a consultant in this presentation right now, think about where our client's cash comes from and where it goes towards. And it's going to be related, generally speaking, to these 3 categories. The one thing before I go too much further is I want to just talk about that basic objective that I have for everybody here. This is something to think about, and you can really drive yourself crazy with the details related to cash flow management. What I hope from the end of this webinar is that you're just a little more thoughtful about something that gives you a lot to think about, which is how you manage your cash flow. So we had talked about money in, money out, the 3 basic categories of where money goes, where money comes from and where money goes. And here we go. Here are some examples. Sales, for example, if you think about that, what is that? That is core to your operations, right? You have to make sales in order to survive. So that's going to be cash from operations. If let's just say you have a situation where you own the real estate that your business is housed in, and you have a tenant or something that's rents received, okay? And that's going to be part of your operating cash. If you extend products and or services to folks on, like, in the spirit of credit, really, that's accounts receivable, that's also part of your operation. But you really want to take a look at accounts receivable when you've actually received the funds, all right? Other things, financing, I mean, if it's loans, especially with loans, you're looking at cash from financing. If you're investing your money from like your savings or, you know, other types of deposit accounts, that's going to be investment cash, all right? And then the money out, I mean, if we're looking at financing, then the money out is going to be the payments that you make on those loans, all right? Operating expenses, if you're on the flip side of things and you don't own the real estate, but you're paying rent, then the rent expense is going to be an operating expense. Utilities, you know, an operating expense. Buying inventory. And then obviously situation where you're putting money into equipment, that would be an investment. That's money out. If you're in a situation where you have shareholders and you have to pay out dividends, that's also money out. All right, so with regard to tools, first off, I want you to take into consideration some practices with regard to cash flow. Recent research has indicated that, well, first off, let me start with this. When you're looking at procuring money from a financier, so let's just say it's a loan company, a bank, credit union, the SBA, they're at the very least going to want you to take a look at your cash flow projections from a month-to-month perspective. But recent research has actually encouraged folks to take a look at cash flow from a weekly perspective, okay? So that's going to require you to take a deep dive of where your money is coming from and what your expenses are. Again, not a hard concept to get your mind around when you get right down to it. It's money in and money out. The neat thing about doing it this way from a week-to-week perspective is that it encourages good bookkeeping. You just don't have the time to let things, lay by the wayside, as it were. And it's a good strategy for solving problems and then finding solutions. Folks, I'm a really big fan of doing things to find out what's going wrong and address them as quickly as possible. And honestly, examining your cash flow from a week-to-week perspective will help you do that. Speaking of perspectives, when you are looking at your cash flow, this is going to be a past, today, and future sort of scenario, okay? So you're going to take a look at your past, what you actually got in, what you actually got out, and how that compares to your expectations. Did that meet where you thought you were going to be? And if not, what went wrong? You're going to take a look at the today of it all, what's on the horizon, what needs to be paid down, and the future also. Like, where is cash coming from? That's where the management of, if you are extending things on credit vis-a-vis accounts receivable, where your cash is going to be coming from and the timing of when it's going to be coming in. And then what other obligations that you have projected. So if you're, let's just say, a print shop or something like that, right? And you need to make an investment in equipment, all right? When do you need to make that investment? How long do you have before the piece of equipment that you have is which is what, 20 years old or something crazy? When do you have no choice but to replace that, okay? And then what instruments, what recourse do you have in order to do that? Do you have reserve cash? Do you have financing lined up, all right? So these are all major considerations. And that's the thing about cash flow when you get right down to it. The concept of money in, money out is relatively easy, but the actual management and the things that you have to deliberate on requires deliberation. All right, so I'm really excited because we actually have an Excel spreadsheet tool that helps to manage cash flow, and I'd like to share that with you guys real quickly. With regard to cash flow, and I'm just going to have to switch out of my PowerPoint just to share this with you. There are a couple of examples that I have. One is through LifePlan, but first let me say that if you go onto Google, first I encourage you to find a process and a program that works for you, okay? And that is able to enable you to examine your cash flow from a week-to-week perspective. That being said, you honestly can go onto Google and just type in cash flow forecast template, and honestly you will find information that that is relevant to the templates, that you'll find something that you can use for forecasting cash flow and for putting your information in. So just give me a second. I just want to share this with you. This is actually a free template from LifePlan, right? And take a look at it. From the leftmost column, you're going to see that you have cash received from, so this actually covers the main three categories if you think about it, right? The cash received from operations, you see that from your cash sales, accounts receivable, cash from loans, so that's the equivalent of financing, right? Cash from financing. And then you have investment cash and then other income. So that situation, like I had mentioned before, rents received. If you have a tenant on the property where your business is housed and you own the real estate, you could put that there. cash spent, so that's operations cash. Your accounts payable is also part of your operations cash. So cash out from operations, money out from loan payments, so that tends to your financing, right? And then asset purchases and dividends, that's all core to your cash out from investments, all right? So on the surface, this looks pretty good. You guys note this also, starting cash balance and ending cash balance. So this is an important thing to share. One period's ending cash balance is another period's starting cash balance, like the beginning of the next month, all right? Whoops, didn't mean to do that. The one thing about this, and this is a free template, so once you download something like this, you can modify it to how you see fit. This is a month-to-month breakdown, all right? And we just talked about examining things from a week-to-week perspective. So obviously that means that you're going to want to modify this. So if you're pretty savvy with Excel, this wouldn't be hard to do, all right? But this is just one example of what you can find on the internet. Now, let me close out of this because what I really wanted to share with you is the one that's been developed through the SBDC. This is actually has its genesis from our friends at the Lock Haven University Small Business Development Center. It's actually merged with Penn State, but this is essentially a pro forma cash flow, and you'll see that this is broken out week by week, with generally 4 weeks grouped together and 4 tabs, each representing a quarter, all right? And in this leftmost column, this example is showing you what things might look like for a projection. And this leftmost column here in green shows the sources and uses of like an opening day for an operation, okay? So again, money in, money out. For an opening day situation, that means that a company like this wouldn't be making money because it's opening day. So what we have here are the various money in sources of funds, okay? So we have 2 bank loans and we have owner injection. And in this example, we have a small business that's starting out with $10,000 in the bank, all right? Now, this is the money in. Right here is the money out. And these are the categories in yellow of the money out for the opening day. Again, when you get right down to it, cash flow, the basic premise, money in, money out. And you see that the money out went to equipment, maybe signage, general things that you'd want in order to start a small business, like a place to actually have one. So real estate purchase is part of it. And you'll see here that the uses of funds, that money out nets the ending balance of $10,000, suggesting that everything that was for this project went to the project costs, and the money that they started out with is actually money that they're going to use as reserve cash for the business, all right? So now we're going into our week-by-week breakdown, all right? And here, we're looking at gross receipts from the operation, the sales. Note that in most cases, if it is gross receipts, that nets out your direct costs or your costs of goods sold if you're like a store or a manufacturer, okay? So this is not inclusive of that. If you're more of a service-oriented operation, for those who are in that, you'll probably note that your direct costs are generally pretty minimal. And then here we have a breakdown of costs from a week-to-week perspective. And again, guys, I was just playing around with our template, so just kind of figuring out figures for you just to see how something like this would work, all right? So you'll see that somebody had a lot of advertising expenses, a lot of fuel. Maybe the operation required them to get on the road like a whole bunch of times. And that is fine, right? You have to work things out between this is something from past life, the size and complexity of your operation, right? And that kind of informs what your expenses are going to be. Maybe starting out, you have a lot of entertainment expense for the first 2 weeks, and that's totally fine, so long as it's relevant and so long as it's appropriate to your operation, all right? So honestly, we are just playing around with expenses here. Some of them are reasonable. Actually, all of these are reasonable, but the frequency play around of relative to what is what's essential to you, all right? This is where it gets kind of fun, in my opinion, but I'm a little bit of a geek when it comes to cash flow, so I would think that. Right now, you're measuring things from a week-to-week perspective. So here we go, cash disbursements, right? That is your money out. Everything here was your money out that you saw in blue, right there. And then that leaves you with an ending balance of a little more than $9,600. So what is that telling me? That is telling me that for your first week of operations, you had to dip into your reserve cash, okay? Again, cash flow management, money out. Is this a bad thing? Not necessarily. It's your first week. You know, it's going to cost money to make money. And quite honestly, in the projections that we do for clients, there is a reasonable expectation that you're going to have good months and bad months. Microscopically speaking, week to week, you're going to have good weeks and bad weeks, and especially when you're starting out. So you see that for that first week, you know, a minor loss, all right? And using a tool like this makes you reflective. So you saw, wow, you know, what do I need to do? Not happy with the first week, although I understand it because, you know, it is what it is, right? And then you're going to take a look at maybe deploying funds, maybe if you upped entertainment or if you reflected on the nature of your operation. That might make a lot of sense. Maybe you had a piece of equipment that wasn't working to capacity. So for week 2, you're going to, early on in the week, devote monies to the maintenance and repairs because you're not working at full capacity. And you're able to up your sales as a result of having, I mean, it's a practical approach, right? Getting people more knowledgeable about what you do and actually having equipment to do your business. And that ups your cash in, right? And then here, as a result, you sustain a bit of a positive cash flow as a result in that cash flow balance, all right? So still dipped into your reserve cash, you're still not out of the woods just yet, but as things progress, maybe it's looking good and you're up, you know, another $500 for the following week. Do you see like there is merit to actually examining things from a week-to-week basis? And then you see that your cash keeps going up. And again, this is just a simple projection from a week-to-week perspective, right? Now from week 4, your cash might go up a little bit too. But this is where the cash flow management of things really makes sense for you to take a deep dive, right? And what do you notice here when you take a look at your operating expenses? All right, you see that everything in its mother is due like that last week, which is a bit of a bummer because things seem to be looking good. You know, and now you have this totally like enormous compared to everything else outlay of cash. And this is where cash flow management makes sense. And as a result, what happens? You know, your net cash flow is almost $2,000. And where it looked like you were doing great in week 3, because you didn't account for things or because everything is coming out from that final week, it's actually showing up negatively impacting your cash flow. And looking at things from a week-to-week perspective, you know, gives you that kind of insight, the timing of situations. And then from there on in, you can figure out strategies that make sense for you, right? And I'm sure you guys can think, you know, man, wow, that's kind of substantial. What do we do in cases like this? And it can be, and the solutions, you know, a lot of solutions can be elaborate. Some of them can be pretty simple, you know. Call up the folks that you have your loans with, call up the folks that you have subscriptions with and talk to them about seeing the change of due date, you know, and having that in place can work wonders also. And you'll see here other things that this makes you aware of in terms of looking at things from a week-to-week perspective. The payroll, for example, and again, I was just plugging in numbers, but this suggests that for this example, right, guys, you are looking at payroll from a biweekly perspective, specifically the even weeks, in this example, weeks 2 and 4, okay? Let's see here. Is there, just want to stop. I know I've been talking a lot, and that's kind of like what happens when you present, right? But if there are any questions, I'm not the best, to be honest, at looking at comments. So I think Joe's going to clue me in if there are any questions with regard to it. The presentation with the Excel.
Yeah, we
Guys,
just
this is
one question, Ray, we just had about where they can access the SBDC cash flow forecast Excel spreadsheet.
You know what? This is something that you can access from us, you know, especially, you know, when you become a client of the Wilkes SBDC. We can discuss this, we can work through it. And you know what? It's a simple Excel spreadsheet. So I'd be totally excited to talk to you about it. This is pretty much like, it is what it is. It's a template, right? So as we have like these meetings, we can discuss what works, what doesn't. If you're not looking at owning your property, then having property taxes isn't an appropriate inclusion as an expense item when you get right down to it. If you have a diverse sales revenue, like revenue stream where sales comes from like a couple of different things because your operation is diversified, we can modify this for you. But yeah, good question. Get it from us, all right? And this is something upon becoming a client, I can just email it to you and we can work through.
We also had another question. Is there a cash flow functionality in QuickBooks?
You know what? There is not really. This is what I'll tell you though. With QuickBooks, there is a system called Cash Flow Tool. All right. Now, it does have much more robust features than say my simple Excel spreadsheet. That being said, it is, I believe that they're running a special between 4 to 6 months for free. It does tie into QuickBooks pretty organically. It's able to do a lot of things for you. Like for example, this is a week-to-week sort of situation. That is a recommendation. It can get into the minutiae of even doing things day to day. I didn't want to go, so that is one product as you research other cash flow tools that you can leverage off of. Full disclosure, I didn't want to really go into a lot of products with regards to this cash flow presentation because it's really not, I'm a little reticent to kind of push products or even have the appearance of that. So I wanted to start off with something simple. But yeah, cash flow tool, I believe it's cashflowtool.com. You can take a look at that. So if that's everything, then I will just continue on. But yeah, this is a pretty cool thing. Like I said before, the genesis of it was from our friends at Lock Haven. So I feel the need to give them props for that. Alrighty, now I'm just going to minimize this really quickly because next up, I want to go through a couple of metrics for you guys, all right? It's just 2 for today, so literally a couple. And that's the gross cash burn rate. And that's the net cash burn rate. Now, when you see rate, I mean, that's a lot of bullet points looking that over. Just think average when you get right down to it, okay? And I'll show you how to calculate these like real easy. And this is something that you can do on your calculator. But if you're building off of the Excel situation that I've just shown you, you can just do it, you know, sidebar it real quickly. So let's start with the gross cash burn rate, okay? And the gross cash burn rate assumes that no monies are coming in. So this is only taking into consideration the expenses that you have and the cash that you have on hand. All right, now you can take as complicated a process in determining your cash on hand as you want to. For the purposes of this presentation, I'm just going to stick with the $10,000. But if you want to leverage off of your personal liquidity, that's totally up to you. You have to take that into consideration. On a case-by-case basis. So let's take a look at what we have here, all right? The total cash disbursements, that is your net, or that is your gross, that drives your gross burn rate, okay? And by default of them being disbursements, you have to assume that these figures are negative because it's money out, right? And then all you gotta do is take the average of your cash disbursements. Now, a lot of folks take different perspectives, but for the purposes of this presentation, we're looking at this from a week-to-week perspective, and essentially over the course of 4 weeks, because again, that's all that I projected. So right now, we are looking at $2,000, almost $2,100, okay, for your gross burn rate for your cash, assuming that you don't have any sales coming in, assuming there was something like a pandemic that happened that completely halted the operation of your business, all right? And you have $10,000 in the bank. So all you want to do is take your $10,000 balance and divide by your burn rate. And I know that's a 5, that says $5, because that's how it was formatted. Let's see if it does it differently here. Maybe I formatted it all that way. Okay, so that's a little bit better, 4.77. All right, and essentially, that's the measurement of how many weeks your cash will last you, assuming gross burn rate, assuming that in this specific example, that you cannot function as a small business, right? So that's an important metric to take into consideration, and especially when you're faced, especially with small businesses recently that have been faced with this, with this pandemic. The next thing is going to be your net cash flow rate. So let's go back to my presentation, and I'll just cover that really quickly, make it big so that everybody can see. Essentially, that's both your cash in, your cash out. On average, again, so you're going to think about it, it seems like a fancy term or whatever, or definition, net cash burn rate. Just think of it as the average of your net cash, all right? Again, I try to keep things, or I want to keep things as simple as possible. And what this is telling you is taking into consideration your operation, how long will your cash last you? We're just going to use this as an example, right? And again, you're going to take the average. And guys, I don't really care how you figure out, how you calculate that. I mean, do it right on the Excel if you want to. Do it with a notepad, and a clicky pen or on your smartphone, so long as you're taking a look at your cash flow and you're taking, and you're applying a deliberate approach. I mean, that's really what matters when you get right down to it. Anywho, so we're finding here a net cash flow burn rate of $98. What this is telling me is that, so if this figure is negative, that means that you are burning through cash. So this is telling me that in this example, even though I have sales, my cash out is outpacing my cash in, my money in. So ultimately, despite the fact that I have reserved cash, this is going to bite me like hardcore. Now, let's take a look here at how this is going to influence my operation, okay? So again, we've taken the average of your net cash flows. We've taken really the cash base, the capital base that you have, which is $10,000, and divided it by your net cash flow. And this figure is actually something that you're going to want to measure in weeks, okay? So even though your cash comes in, cash comes out, cash positive, some weeks, cash negative, if this 4-week period is replicated over the course of almost a year, because this is, or 2 years rather, because this is a week by week figure, 52, right? 52 weeks in a year. Ultimately, if things keep going this way, you are going to look at a significant, you're not going to be making money, or it's going to show, it's going to really manifest at the end of 2 years, okay? It's probably going to manifest a lot sooner, but this is an indicator that the cash that you have in place will only last for a finite amount of time, okay? So any questions with regard to that? And it doesn't seem like there are, and that is totally
I have a question.
okay.
So what is the significance of it being negative 102? Is that number reference anything? Like the 4.76 was number of weeks.
102 or 100, I guess it's going to be closer to 103. By default of just the math, right? It's going to be a negative number because when you take like a positive and divide it by a negative number, you net out a negative number, okay? But still, that's going to be a measurement. That's a great question. That is a measurement of weeks. So that's when I said you have about 2 years for your cash to last you, taking into account your net cash flows, because that's a week figure, okay? So 100, or if you want to break it down, 103 weeks, okay?
That's also, so they're both weeks. So the first one was a shorter period of time based on how much you had to pay out. And then the second one was a longer period of time based on how, I'm trying to distinguish what the difference those numbers are.
Absolutely, absolutely. And it's one of those things, let me backtrack a little bit, okay? Now, it logically follows that if you're looking at a gross burn rate and you're not taking into consideration the possibility that you're making any money, that you only have expenses to contend with, your cash is by nature going to burn out a lot faster, right? So that's where that 4.76, almost 5 comes into play, because you're not actually making any money. So the $10,000 that you have at the ready, in a manner of speaking, is going to burn through, all right? Now, when you take into your account, and you have about 5 weeks, a little less than 5 weeks before you burn through that $10,000, okay? In the second example, we're looking at net cash flow. So essentially what that means is you're going to take all of your money in, okay, less your money out from a week-to-week perspective. So you're still looking at things in this example from a 4-week perspective, right? Now, if you add all these figures up, you're going to find that even though you have some weeks, the second and third week, that show up positive, that ultimately over a 4-week perspective, you're going to have a negative cash flow, all right? And when you take the average of all 4 weeks of your net cash flows, you're going to have a negative figure, all right? So now if this figure were to show positive, then that's going to be a different story. Then it shows that you're actually building cash. But when it shows up negative, when you're looking at your net cash flow situation, that means that you're burning through cash. So that's already a red flag, right? And what you do is you take into consideration the 10,000 divided by the average rate at which you're burning through cash on a week-by-week basis. Now, if you really, really wanted to, you can also, it doesn't matter to me, you can also, if you wanted to do things from like a month-to-month perspective, the same math, so to speak, applies, all right? Now, when you take the $10,000, right, that you start off with, and divide by your negative cash flow, your average net cash flow, you're going to get 102, almost 103 weeks. You're going to look at that from a week, that's a week figure. And what that means is that over the course, after the 2-year mark, you're going to lose you're essentially going to lose all your net cash, all that $10,000 balance, because that's how long it's going to last you, all right? If the 4 weeks that we're seeing is replicated over the course of 2 years, this is what you can expect. What this means for you in terms of managing your cash is that you are going to have to make significant changes to your operation, you know, and hopefully before the 2-year mark, in terms of how to diversify cash in, how to control expenses, things of that nature. So I hope that makes sense. I know that it's a little wacky because the negative figure does kind of throw people off, but I hope that kind of adds, you know, a little more clarity for you.
Definitely. I have another question then too. If that number came up positive, what would happen at the end of 103 weeks?
Well, at the end of 103 weeks, well, you know what? Honestly, it's going to be a lot sooner. That's going to articulate to you that you're actually building cash, okay? And that's a good thing, generally speaking. But you also want to take into other things with regards to your creating capital. And some of them is your strategy and your thoughts in terms of your long-term goals, all right? And whether or not the rate at which you're building cash is enough to sustain, is enough to realize your long-term goals. We use equipment, for example, right? If before the 52-week mark, you're looking at purchasing equipment through the utilization, through the deployment of cash from operations, right? Cash from sales. That's awesome, but you also have to reflect and figure out whether the rate at which you're realizing, which you're building cash is going to be enough for you to realize that ultimate goal. And if it's not, then you have to take a look at other avenues for cash flow, all right, specific to that end goal. Maybe it's, and you know, probably the most common thing is to look at financing instruments to do that for you.
Thank you.
So yes, long story short, and that's a great point. Let me drive that home. Take like 10 seconds. Net cash flows, when you're looking at net cash flows proper, if the figure is positive when you're looking at the average, that means you're building cash. If the figure is negative, that means you're burning cash despite the fact that you're ultimately burning cash on average, despite the fact that you're making sales, and despite the fact that some of your months might actually be positive, might actually show positive cash flow, okay? But, and again, I think this is so cool because it also articulates the merit of looking at things from the week-to-week perspective. So yeah, this is really cool. This was a little bit about my Excel spreadsheet for you guys. Again, this is going to be readily available. And if you don't mind, I'd really like to just go into some of my final thoughts with regards to cash flow, all right? You know, it's not a great thing to reflect, but it's kind of necessary in terms of like where we are today, to take a look at the signs of crises. What's making you anxious? And you know, it's funny because it's very reflective when you get right down to it, right? Like, what are your behaviors? How are you feeling? Are you anxious about paying your vendors? How much are you looking at your savings and your equivalents to sustain operations? Because when you get right down to it, nobody is actually going into business, you know, I mean, it's not a sustainable model to just, you know, invest your savings and to borrow money for business. Ultimately, that's going to lead to a problematic situation with your cash flow, right? What does your debt look like right now? And are you relying on it to cover operating expenses? So we took a look at those operating expenses from a burn rate net, from a burn rate perspective, both from gross and net, you know, and if it's continuously negative and you're borrowing money, right, to make ends meet, you can't catch up to that, or maybe you can, but it's going to take significant restructuring. And these are things that you just want to be aware of as you manage your cash flow. This next point has to do more with accounts receivable, okay? Are you getting paid with your customers, from your customers? If not, what's going on? You know, and in my experience, sometimes it requires you to have, you know, a heart-to-heart situation with your clients and customers, and to figure out what's going on and what can be done, and then figuring out maybe different strategies for you to actually collect on your receivables. You know, maybe it's extending time you already have if it seems feasible. Maybe that's the one thing to do. Maybe in terms of your actual cash flow, all right, let's just say you need capital sooner than later, and you can get by with 90% of what the outstanding receivable is. Like, does it make sense to have a program where there's a discount of maybe 5 to 10% in order to get the money faster? If you're not paying yourself, you know, especially After you've been in business for like a year or two or more, you know, that's definitely a red flag. And then how long can you handle the trends in cash? And that's why looking at the burn rates is so important, because that's going to let you know, like, wow, how long can we sustain this situation before we need to make significant changes? All right. And once you see that you can't sustain it for long, at that point, then you can start to reflect and consider things to do. Strategies, you know, start now in terms of managing your cash flow. There's a lot to think about, so write your ideas down. Start from a place of simplicity. Again, the whole money in, money out, awareness of your due dates, outstanding debts, timing when you get your money is going to be really important. And again, just to examine things on a weekly basis from a past, present, and future perspective. And then let that inform your strategy with regards to your operation. It's not always an easy process. At the same time, it's not always a complicated process. And then feel free to work with your local SBDC to sit down, discuss your questions and concerns, but also have meaningful discussion with your accounting professional as another means to inform your strategy for cash flow management. So I think for all intents and purposes, everybody, this is what I have for you. My email is there below in case you have any questions. Are there any questions? Joe, if you wouldn't mind, if you see anything, because I'm just terrible at.
There are any in the chat box. Feel free
Okay.
to hop on and ask any questions.
I have another question.
Sure.
As far as getting paid by customers, so I currently am running a small business, and I wanted to find out where I can find where the information is I'd like to add interest to the bills or to the invoices. How much can I legally add, and who might know that information?
You know what, honestly, a corporate or tax attorney would probably be your best bet for that sort of question, all right? So I would defer your inquiry to your attorney. If you don't have an attorney lined up, that's a simple fix, and reach out to the folks at the Penn State Law Clinic. They should be able to guide you with regard to what you can charge in terms of interest. And then, or if not, they can point you certainly in the right direction. Okay, but that's a good question. You know, and this is a situation where, you know, maybe a question comes up like 5 minutes after the presentation, 10 minutes after the presentation, and that is totally cool. You know, my email, my contact information is right there. Feel free to reach out to me. But I guess if that's everything, happy Friday to everybody, and have a great weekend.
Thank you, Ray, for sharing your insights and being here with us today. I have just a few housekeeping notes before the webinar ends. I will be making available the recording of the training on the Wilkes University SBDC YouTube channel, and I will email that link to all attendees. Also, I'll be emailing a link to the post-event survey so that we can determine which of our resources will best suit your needs and what topics you would like to see as training sessions in the future. And one last note, we have a new training session, Ensuring Resiliency, Creating a Business Continuity Plan, which will be held on Monday, October 5th at noon. So I do encourage you to go to our e-center to sign up for that. And you can also find the link for registration through our website, Facebook, and LinkedIn pages. With that, I want to thank everyone for attending this training. And if you have any questions, please do not hesitate to contact us at the SBDC. I hope that you all have a wonderful rest of your day, and I look forward to seeing all of you at future webinars. Thanks so much, everyone. Bye.